Good morning, friends. Just getting into our presentation, the significance of themes in equity investing. So first, let's understand what are themes. So themes are something like exports. Now, the export theme could have multiple sectors in it, right? So export could be of commodities, exports could be of textiles, exports could be of autos. Or let's say themes could be consumption, right? Within consumption, the various sectors could be real estate, it could be again autos, it could again be FMCG, right? So there are themes, and within themes there are multiple sectors. But the question arises, why are themes important? This question we try to answer with this slide. In this slide, we've put in all the indices of BSE and NSE, the sectoral indices, and we've taken their 3-year CAGR returns over here from 2010. So basically, the return starts from 2008 because these are 3-year CAGR returns, and we have taken the top 5 sectors of each year. There are 3 key points which are apparent from this slide. First, there is no evergreen sector. There is no sector wherein this green line continues forever, right? The second key point, every sector has a run for a few years, right? So if you look at, let's say maybe the BSE Auto Index, it went from 2010 to 2016, it had a very good run. The third key point, whenever a sector has a good run, that streak typically goes on for a period of maybe, 7 to 8 years. So, we can look at maybe the BSE FMCG index. We need to add 2 years to this because these are 3-year CAGR returns. We can look at the BSE Auto Index, we can look at the Consumer Durables Index, we can look at the Healthcare Index, right? So this highlights to us that theme selection is absolutely key for alpha generation. Let's take an illustration of the same. If we look at the chemicals industry, and this is a chart that we've made of the key chemical stock prices. If you look at this red line below, right, this line from 2009 till today has given a CAGR return of 35%, right? That is long period investing. Or let's say if a person follows all the stages of the business cycle and remains invested, that is the kind of return one is expected to make in the chemical industry. So this is the nascent stage, this is the high growth phase, this is the stable to mature growth phase. But if we select only the high growth phase of a business, which is the blue line, the CAGR return changes from 35% to 42%. We've been big investors in the chemical industry. For some of the names, we are actually some of the largest institutional holders. We've held through the cycle, but this chart highlights the fact that if you highlight only for the high growth phase, the kind of returns that one can possibly make. Now, while the complete business cycle would be 10-year plus, the high growth phase maybe is from 2015 to 2021. So it's a 6 to 7 year period when this phase lasts. Let's look at the key drivers of this phase. So this is the result, the stock price. But let's look at the market share of the Indian chemical industry. It has gone up from, let's say, about 1% to 3% during this period. And if you look at the profit margins of the companies, which is this blue chart on the right hand side, profit margins have increased from around 4.5% in FY15 to triple the levels in FY23. So the characterization of the high growth phase is a very good growth in revenues, a very good growth in margins, which reflects in stock prices. I'll skip this example. and move forward. This brings us to our portfolio, which is the ASK Lighthouse Portfolio. In this portfolio, our intention is to invest in 3 or 4 themes or sectors at a point in time. We remain invested in those themes for a period of 2 to 4 years, and then we move on to the next theme or sector. Which are the themes that we've currently selected? It is manufacturing, it is infrastructure, it is energy, and it is defense. So these are our focus themes, and we believe that all these themes are in the high growth phase. And why these themes are in the high growth phase? This chart highlights the capital expenditure by the government of India as a percentage of GDP. If we look from 2006 to 2020, basically the range was around 1.6 to 1.8%. Even if it went up in 1 year, let's say in FY 2008, it went up to 2.4% of GDP. The next year again it came down. So there was no structural sustained increase in government spending on infrastructure. Now let's look at what has happened post-COVID. In COVID, in FY21, there was a good increase. It seemed as if the government is kickstarting a COVID-impacted economy, which was very natural as well. Let's look at FY22. The number again increased by around 15%. From FY21 levels. Again, the argument was largely the same, that this is government to help a COVID battered economy. But this number again increased in 2023, right? And if you look at FY25 levels, that number is more than double of FY20 levels. And let's not forget that our nominal GDP is also rising during this time. So the actual expenditure in nominal terms, absolute terms, has actually more than doubled and closer to tripled. That is the kind of spending that this government has done on infrastructure, on the manufacturing space, which has helped give the business transformation momentum to these sectors. On top of this, we will also see spending by the state governments. Let's say perhaps there are new government formations that have happened, and those governments in respective states will accelerate spending on infrastructure. And over and above this is going to be the spending of the private sector. Now, the private sector capex cycle has been relatively muted for the last couple of years and last few years, and that is obviously because COVID impacted demand and private sector wasn't investing, except maybe in a few industries like chemicals, solar, etc. But sustained private sector investing is expected to pick up in the second half of the year. Now let's take a few examples. What happens when there is so much increase in spending year on year? There is a snowball effect that happens. It becomes very difficult for linear thinking human brains to fully appreciate the extent of impact. While we know that the direction of impact is upwards, but how much is the impact? To quantify it becomes absolutely difficult. So in this scenario, governments get surprised, planners get surprised, corporates get surprised, employees get surprised, and investors get surprised. It is a surprising phenomena for the entire ecosystem because of this snowball effect, which has a multiplicative effect as things multiply because of sustained increased spending. So let's take examples of the same. So if we look at, let's say the power sector. The power sector, we have a total capacity of roughly around 450 gigawatts. The government plans to increase this capacity to 900 gigawatts by FY32, and China's current capacity is more than 3 times this number of FY32. And the government is continuously increasing its capacity addition targets. Because if we want more manufacturing in the country, and if our own digital consumption is increasing, if there are more EVs on the road, it essentially implies more power consumption, right? That is why, let's say from about 1.5 years ago or so, the government has actually been continuously increasing this thermal power capacity additions, and that is why the reflection in the stock prices related to that sector. Let's look at ports. So this story is not only about power. This story is across various sectors. Let's look at ports. Indian ports handle about 1.5 billion tons of cargo combined. The ports in China handle about 15 billion tons. So China as an economy is about 5.5 to 6x our size. But when it comes to port capacity, it is 10x, right? This highlights the kind of potential that is ahead of us. It is not that this potential wasn't there previously. There were various dots. We had to connect those dots. We had to energize those dots. We had to give them direction. And now, since COVID times, we've seen that that process has really picked up pace. Defense is the other example where numbers are expected to more than double in terms of spending. And what are the key drivers? If you look at indigenization or Atmanirbhar Bharat or import substitution, which is highlighted by these green bars. So domestic production is increasing, import is decreasing. That is one aspect. The second aspect is the fact that now we are exporting. We are exporting to countries in Asia, we are exporting to countries in Africa, and these markets relatively took a far longer period of time to approve our products historically. But now, you just see the kind of increase that we are seeing. Let's say from a low level of 2%, that number has gone up to more like 15% last year. Manufacturing. In manufacturing, we've seen various programs by the government. There are phased manufacturing programs, there are production-linked incentive schemes, there are various other fiscal incentives, there is ease of doing business, and this is across various sectors. It is not only in, let's say, electronics, it is in textiles, it's in autos, it is in drone manufacturing. Now, let's take a few examples there. Of how everyone is getting surprised. So Apple in 2017 manufactured in India 0% of its global production. Today, they are manufacturing 12% of their global production in India. Their initial target was 5%, and now the target is 25% by FY27, and perhaps it is going to go up to 50%. So from 0% 6 years ago, that number is 12%, going to 25% in 3 years, in 2 years, and then maybe going towards 50%. The value addition is still low. It's not very high because it's largely an assembly kind of an operation. Gradually with time, that value addition is going to increase. So just imagine the world's largest, one of the world's largest mobile manufacturers who was basically absent in the country in terms of production, could potentially have 25 to 50% of its production coming from India in the next 5-7 years. That is transformation. That is change. That is surprise. We want to play that surprise in this fund. We know the direction of surprise. We don't know the extent of surprise. We don't know the shape of surprise. We don't know the form of surprise. But we know for sure that it is going to surprise. There are many other examples. Let's say if you look at the semiconductor industry, I don't know how many of us would have actually believed that the semiconductor ecosystem could start to come to India. Obviously, there's a huge road to travel. we'll start with very basic stuff in the beginning and then gradually build on. But at least that journey has started. Even let's say maybe a couple of years ago, many of us wouldn't have believed that anything meaningful is likely to happen in that area in this country. So what are the key aspects of this portfolio? Firstly, this is a focused portfolio. We will be investing only in 3 to 4 sectors. This is not a diversified portfolio. And in this portfolio, we will be selecting themes on a top-down basis, while we will be selecting stocks on a bottom-up basis. We are likely to hold a particular theme or a particular sector for a 2 to 4 year time period. And once that theme has aged, we will move on to the next theme. So it is not that these themes are permanent. It is just that currently they are in that high growth phase and we want to benefit from the same. How do we select themes? That becomes the key. So A, we will select themes on a top-down basis. So as an example, let's say infrastructure and manufacturing are 2 of the key themes here. Within each theme, we will map out various sectors. So let's say within infra, there is roads, ports, airports, power. Then within each sector, we will take out the subsectors. So we have thermal power, we have hydro, we have renewables, nuclear. And then within each subsector, we will make out the complete value chain, right? So let's take the example of thermal power. So we have invested in a power financier. Currently, we are not invested in a utility, but then we've invested in a power plant builder. We've invested in someone who supplies power plant equipment. We've invested in someone that makes transformers. We've invested in someone that makes conductors, that supplies that power. That power reaches our home. We've invested in a cables and wires company. For thermal power generation, we require coal, so we've invested in a coal company. So that is the way we are going to go about our business. But in selecting those stocks, we will follow a bottom-up approach. Now, how do we select themes? What are the key criteria? Firstly, there needs to be a structural transformation undergoing in the theme or the sector. Only when there is structural transformation, we are going to see these very high growth levels. What do we mean by structural transformation? The transformation needs to be deep. It needs to alter the way business is done in that sector for all companies. So it's like a rising tide which will lift all boats, but obviously we will select the boats that we want to ride. Also, the transformation needs to be long lasting. If we want to play 2 to 4 years, at least the transformation should be visible for the next 8 years or so, 7 to 8 years. We cannot be playing transitory shifts. This is not a short-term portfolio. This is not a trading portfolio. So let's say if the government decides to reduce export duty on sugar, it is not that we'll invest in the sugar sector because that benefit is maybe for 6 months or a year. We are not interested in that. It needs to be long, deep, structural, deep-rooted, which will change the way business is done. If you look at the portfolio, every single business is undergoing a massive transformation because the sector is going in a massive transformation. We will obviously be changing sectors every few years. Few years does not mean a year or two. It means more like 2 to 4 years. This is medium-term investing. All our other products are 5+ years. This is not less than 1 year. This is in that medium bracket of 2 to 4 years. In terms of stocks, we would be holding around 15 to 30 stocks. So this is going to be a concentrated portfolio. For narrow themes, the number of stocks are going to be more towards 15. For broader themes, the number of stocks are going to be more towards 30. The current themes are quite broad. So we have around 28 stocks in the portfolio. Now, how do we exit themes? we've seen how will we enter, but it's just the opposite of the way we select themes. So we are selecting youthful themes because youth is able to run faster, youth is able to run longer. So when a theme ages, we get out of that theme. Or when we believe that a large part of the value creation that we expected has already played out, or basically the sector has already juiced out in terms of returns or expectations or valuations. Or if we find something which is more attractive, then we jump on to that ship. But the idea is that we will be not remain invested in a particular theme for a very long time, and that we will exit them when we believe that most of the returns that we expected have played out. Now, what are the risks to this approach? Every investment strategy has a risk. So there are three key risks associated with this approach. The first risk is that we select a wrong theme. We select a wrong theme and it goes down. We don't believe that the themes that we've selected are wrong because, as we've seen, there are structural changes in the economy, plus generally a theme runs for around 7 to 8 years. So this is a fund which is not investing only in manufacturing. This is not a fund which is investing only in defense. This is not a fund which is investing only in infrastructure. This is not a fund which is investing only in energy. It is investing in all four. So we have that ability to play around the themes as and when we see more opportunities in a particular space. So currently, the portfolio has around 60% infra, 20% manufacturing, 10% energy, and 10% defense, because that is how we are seeing the opportunities today. The second biggest risk is that we identify the right theme, but valuations are full, so we get in at the top. We don't believe that is the case with this sector. While obviously stock prices have gone up from where they were, our view is that in the last couple of years, from suppressed valuation levels, stock valuations have normalized. Obviously, in some pockets, they've become overextended, but generally they've normalized. So then how will we make money? That ship has sailed. We are not looking at making money from normalization of valuations. We expect to make money from three key levers in this fund. Firstly, we believe that growth itself is going to surprise on the upside. So if you look at our portfolio today, around 2/3 of the companies actually surprised us on earnings even in the quarter gone by, right? As I said, we are playing the direction of surprise. The extent of surprise, I think, is going to be higher. The second lever, which will help us make money, is the longevity of growth. We don't think that this is a theme for 1 or 2 years. We think this is a decadal plus theme. So the growth runway that is available to us is very long. And when we combine higher growth with longer growth, the effects are multiplicative in nature. They are not additive. The third lever which will help us make money is the structural re-rating of valuation multiples. And what do I mean by that? When businesses grow fast and for a longer period of time, business scale improves, business size improves, business robustness improves, the predictability, sustainability of businesses improves, their ability to attract capital, talent, leadership, technology, infrastructure, all of that improves. And that helps re-rate the multiples structurally. So, maybe we can take the example of the FMCG sector. It has been growing at a roughly a rate of 10% for a long period of time, other than the last few years. And its multiples used to always be 50 times plus. Why? Because of these factors: long runway for growth, predictable earnings, and structural re-rating of multiples. So in this cycle, this journey, we don't think we are here also. We are perhaps somewhere here in our view. So there is maybe another 5 to 6 years to go, and we look at playing 2 to 4 out of this. Now, just the last slide of the presentation. This is a sector agnostic portfolio. We don't have any market cap allocations in mind because we select stocks on a bottom-up basis. Currently, 40% of the portfolio is in small caps, 20% is in mid caps, and 40% is in large caps. But these allocations could change over time as we find attractive businesses. While selecting businesses, we don't have any quantitative parameters in mind, but there are three key qualitative parameters. Firstly, we will not compromise on the quality of management. Secondly, we will invest only in those businesses that have strong competitive moats. And thirdly, we want a margin of safety at the time of investment. We are not looking at chasing momentum here. This is not a momentum strategy because momentum has short-term connotation less than 1 year. This is a 2 to 4 year investment, but it doesn't mean that we'll necessarily always remain invested for 2 years. If stocks give returns ahead of our expectations, we are fine to exit them early, but we are not looking at trading. Also, when a sector has a rising momentum, the worst stocks actually give the highest returns. But we are not investing in bad businesses. We want only leadership businesses that will create extraordinary value over a period of time. There are no sector limits. We could change between these 4 sectors as we want, but from a stock perspective, we will not invest more than 10% in a particular stock. The benchmark for this fund is BSE 500. So thank you so much, everyone, for your patient hearing, and hope you have a good day today. Thanks a lot.